In a widely anticipated move, the U.S. Central Bank cut interest rates for the second time this year to help the country tackle the high cost of borrowing. And for more on that rate cut and other remarks made by Fed Chair Powell on Thursday, we turn to Greg McBride, Chief Financial Analyst at Bankrate. Hi, Greg, how are you doing?
Good. How are you, Elaine? Thanks for having me this evening.
Well, no surprise, as we know, but how do you think this interest rate cut will impact inflation trends in the United States for the rest of this year?
Yeah, we're in this position because inflation has come down so dramatically. It's really close to the Fed's 2% target. So they've got this comfort level where they're able to begin reducing interest rates, essentially taking their foot off the brake pedal slowly so that interest rates aren't such a barrier to economic growth. They want to go slow enough that they don't stoke inflation again, but at the same time, they don't want to go too fast. And risk the health of the overall. They don't want to go and trigger inflation, but at the same time, they also have to balance the labor market. And so they've got to walk a fine line between how quickly or slowly they move with interest rates based on those two things.
And that being said, do you have any sense of what we could see next month in December?
I didn't see anything in the Fed statement or in Chair Powell's press conference that tells me they're inclined to pause in December. Every indication seems that they're inclined to cut. Of course, the economic data has to support that, but I think that's really the bias, and they seem to be some time away from being comfortable taking a pause. I think at this point, they still view interest rates as being restrictive, as something that could hold back the economy, and they want to slowly continue to move that lower before they start thinking about stepping to the sidelines for any period of time.
So, Greg, we're close to that neutral rate, as you mentioned. What are some of the potential challenges there, though, if inflation stabilizes at levels above the target rate?
I think a lot of that depends on how much above the target rate it would be. There's not anything in the economy right now that's compelling the Fed to cut interest rates in a particular hurry. So, if inflation stalled out above a level that they were really comfortable with, they could, move to the sidelines. They could hold interest rates at current levels for a while longer if they felt that was what was necessary to get inflation down closer to that 2% target.
Home buyers have been watching for months, and they were hoping for a little bit more relief. Why are markets pushing mortgage rates higher even as the Fed is cutting rates? I mean, there's just not that big impact or immediate impact that people are hoping for.
Yeah, there's not. And what the Fed is controlling is a short-term interest rate, but mortgage rates are tied to long-term interest rates. And sometimes they can zig when the Fed zags, and vice versa. And that's what we've been seeing is the Fed's cutting short-term rates, but mortgage rates have bounded higher over the last 7 weeks or so. Up to 7% now. It's not limited to just mortgage rates, long-term interest rates, everything from government debt, corporate debt, as well as mortgage rates have been moving higher, but it complicates that problem for aspiring homeowners. Not only are home prices high, but so too are the financing costs.
What are some of the economic indicators that might cause the Fed to pause its rate cutting plan after December?
I think if you started to see indications that inflation was picking up, if they've lost confidence that inflation is making its way toward 2%, I think they would move to the sidelines very quickly. It's likely to be quite some time before we get any sort of type of policy enacted that the Fed could model out as being inflationary. I don't view that as necessarily right around the corner, but there could be other factors that push inflation up just enough to make the Fed uncomfortable and push them to the sidelines.
And Greg, as we all know, the big news this week, Donald Trump coming back to Washington. How could new fiscal policies from his administration affect the Fed's approach to future rate adjustments? I mean, Powell didn't really say that much today regarding a new Trump administration. But look, we know what he had before. What can we see there at the beginning of 2025?
I don't know that it's going to be the beginning of 2025. I think we'll probably be well into 2025. But I think the concern, and you see this in the rise in long-term bond yields, is that some of the government borrowing and some of the just things that like tariffs that could be inflationary, that could force the Fed back into a situation where they're not only not cutting interest rates, but then we get back to a situation where do they have to raise interest rates? But again, I don't think that's an early 2025 thing. I think that's probably more toward the middle of the year.
Any anticipated challenges or concerns with that new administration coming in?
No, but that's not really my wheelhouse. Sorry.
All right. Greg McBride, thank you so much for joining us. We appreciate all of your insight this evening.
Thank you, Elaine.